Oh, you. Hello, everybody, and welcome. I'm Bonnie Helper. This is our online investor insights. We host them every 2 weeks, and I write every week. I send out the Startup One Step newsletter. I'll put the link in the chat later. And I also work with founders, helping them with their pitch decks because none of them know how to do it properly, right, Glenn? We get results, and then make introductions to investor where and when appropriate. So I want to thank Joseph Katz for hosting us. Thank you, Joseph, and tell us about what you do.
Thank you, Bonnie. Thank you, everyone, for joining today. Joseph Katz. I help companies go from unknown to well-known, going back to the basics of marketing, and help companies plan for long-term growth using strategic marketing. And happy to be here. Happy everyone is joining us today. It looks like we're going to have a great conversation.
Oh, it's always a great time. We should invite Glenn back more often, as long as his travel schedule permits. So, Glenn, do you want to introduce yourself and tell us a bit about your background in Quake Capital? Or you want to meet the attendees first?
I'll go ahead just real quick.
Okay.
I'll try not to waste too much time, but I've been in the tech world as an operator or an investor since the early 90s. I had my first big break. I took over and built a startup. I'm actually in the Bay Area today, so I'll say here in the Bay Area. In 1996, went on to become a very successful IPO, about a $4.5 billion IPO with, back for those of you old enough to remember, Lehman Brothers. Yes. And that'd probably be, I was trying to figure this out the other day, Bonnie, you'll get a kick. I think it was about 40 billion in converted value today. So it was a really solid exit, obviously. And then from there, had 13 other startups and a total of 9 exits with 3 public offerings. So as a very active operator, and at the same time, I was doing a lot of angel investing, or I guess you wouldn't really call it that necessarily, because I formed a family office in 1999, 2000. And so I invested in a couple hundred startups on my own over a 20-year window of time. And then I launched Quake in 2017. And that we've done 280 investments across 3 primary funds. We invest very early. Our typical entry valuation is about 3.6 million. Range of values of our companies now under management is between, well, I suppose 0 for some and as high as 400 million for others. Big differentiator for us, I suppose, that's important for anybody listening to be Jabber, is because we focus a lot on what I would call on-base percentage as opposed to home runs. So I think it's a fool's errand to hunt unicorns. Obviously, I built a lot of companies. I had 14 that I would have told you were all unicorns, and 5 of them were abysmal failures. And obviously, I had a few unicorns, but I thought they all were, and I was the person most likely to be able to tell you what the outcome was going to be. So I think it's really difficult for somebody on the outside to determine that. So we don't do it. We try and focus on predictable, basically survivability, the ability to monetize and exit a company. And if you look at our rates, we've got about 85% survival about 6 years in on the portfolio. So really different than a typical venture fund. So that's a lot, but that gives you a real good idea of how we're very merit and metric based. So we come at it from a data science perspective. And if you ever want to get into it, I'll tell you why most of the data in venture is wrong. And there's tons of proof that it's wrong. Most of the stuff that people look at, I'll give you quick examples. Geography, you don't have to be in the Bay Area. That's complete hogwash.
No one's there anymore.
the data just doesn't support that. Cherry pick data supports it, but Startup Genome Report is probably the best data. It's not even close. Age doesn't matter. Where you went to school doesn't matter. Where you work doesn't matter. Most of the stuff people focus on doesn't matter. So in any event, we do it a little different based on our interpretation of that data. So anyways, that's us.
So
who wants to go next?
Yeah, who wants? Sam,
Yeah, sure. And as one of Glenn's portfolio companies, I guess this is a good spot. I've known Glenn for about 5 years because we were part of his New York cohort in 2018. and had a great experience actually. It was super just working with some of those other entrepreneurs and the folks that ran the program. And then since then, Quake invested in us. We've since done some other accelerators, raised about $500,000 equity crowdfunding. My company, Axle AI, does applied AI for video, and particularly in video search, where content creation is a booming business, and everybody from YouTube creators to corporates are accumulating crazy amounts of video, and then they can't find anything and they can't do anything with it. So we help them basically repurpose that, and it's a growing business. So that's me.
Thank you. Catherine.
Yes, hi. So I'm not very much in the tech space, but I've started working with a few different companies in that area. And my background is in the media content, what Sam just said. Your name is Sam, right?
Yes, that's right.
Sam. Yeah, so I was trying to write that down when she called on me. So because I find that's really interesting what you're doing. But so AI is one of the areas that I'm tiptoeing into. But we're involved. My company is 23 years old, and we're a very traditional media entertainment company that I keep trying to, adjust to the ebbs and flows of all the changes in the landscape that's going on now. There's a lot going on and not going on at the same time with the strikes and so on. But so I'm in the more traditional. My core business is more traditional, but we're developing new content and sort of bridging into using more online and technology. So, for example, one of my producers who's in Canada, we have a series with CBC where basically
we have to keep these short because we have a lot of people and we do want to hear.
Okay, so we're using AI in content creation too. That's it.
Okay, thank you. Ian.
Thank you.
Thank you.
Hi, everybody. Ian Garmaze. I'm in Toronto. I am currently the COO of Virtual Film School. We're an online film school and currently doing most of our business in Asia and Africa. And happy to be here.
Thank you. Mark Weissman.
Thank you. Hi, Mark Wiseman, Managing Director with Navidar. Glenn, we're an Austin-based investment bank focused on working with middle market technology companies doing sell side M&A and capital raises. I'm based in Cleveland, Ohio, and love coming to meetings like this and learning what all these early stage and startup companies are up to, because it's usually very exciting and interesting. Thanks.
Yeah. Names keep dropping. Pierre, are you able to introduce yourself? Oh, you can come back. Ray.
Hi, Bonnie. Thanks for inviting me. This is my first one of your webcasts. I was at Lehman. I worked at Lehman, was there when it melted, and basically got it to Barclays. I am now on the entrepreneurial side. I'm the founder of a digital platform that moves digital assets entirely over the internet using your phone. So it takes away all the intermediaries. We have been speaking to the MBA. Our first project will be launching personal greetings with video and customer loyalty directly on physical products with the tap of a phone. We have videos. As I said, the MBA reached out to us to discuss our technology on an unsolicited basis. So we are making good. We've signed with digital agencies, and happy to speak to any of you on this call. And thank you for providing the insights, Glenn and Joseph and others. Appreciate it.
Oh, thank you. Daniel. You're muted. Oh, there you go.
Hi, everyone. I'm Daniel Greenblum. I'm the founder of Catch, where we're building tools to protect individuals from cyber scams. So honored to be here. Thanks for having me.
Thank you. Andrea.
Hi, good morning, everyone. My name is Andrea Liu. I previously practiced law, and one of the cases I worked on was the Time Warner AT&T merger. So I'd love to talk to some of you good folks about content delivery and interesting ways to leverage AI in the ad tech, gaming, media tech space. I'm currently working for a Hong Kong family office, sourcing and diligencing investment opportunities in the US. So yeah, happy to learn and chat more with you guys. Thanks. Thanks, Bonnie.
Thanks. Deborah.
Hi, everyone. I'm Deborah Lee. I'm here in Pittsburgh, Pennsylvania. I have 18 years of banking, and now I am an entrepreneur working with Bonnie, and we have a company called Debonair. Deborah and Bonnie, Debonair. Bonnie came up with that great name, Debonair Consulting. So we work with startup founders in preparing you for funding. We help you with your pitch decks, executive summaries, and introduce you to our networks of investors. That's it.
Deco. And good to see you, Deborah. Oh, Deco, you're muted.
You said Dejo?
Oh, Deco, I'm sorry.
No worries. My main background is director of e-commerce, so that's managing Amazon, Walmart, Wayfair, Overstock, Home Depot, RangeMe accounts. I also have an income tax software preparation and assistance background with Intuit TurboTax. AI related, I'm currently also a business rep for a fintech AI company. It's called FinGPT AI for Finance. Just a brief intro on that. So scraping SEC filings, Yahoo Finance, and different data sources in order to analyze thank you reports and potentially have work that analysts do. Best part about it on a competitive edge is that every training reiteration costs a couple $100 compared to, let's say, Bloomberg GPT that costs $3 to $5 million.
Oh, thank you. Stuart, good to see you.
Thanks, Bonnie. Good to see you. So my name is Stuart Silverman. I'm a longtime retail tech guy and founder of Becco. So Becco is a B2B SaaS customer feedback platform where we're capturing the sales behaviors of each and every frontline store associate, and then using that data to help them improve their skills, drive more sales, and get recognized for their achievements. In a pilot program that we did with a cosmetics retailer, using the Becco customer feedback data, they were able to see a 27% improvement in store associates adhering to their best practice processes, which then drove a 6.7% increase in the average sales per shopper.
Thank you. Hey, Dean, good to see you. Why don't you introduce yourself?
Thank you, Bonnie and Joseph, for hosting this. And Glenn, I'd love to hear about your background. I've led 3 startups through financing to acquisitions by publicly traded companies and 1 through an IPO. And now I'm founder and CEO of Red Sky Health. We're using artificial intelligence to remediate health insurance denials for group practices and hospital systems.
Oh, thank you. David, sorry. Dean is one of the founders I'm working with. David?
Is there more than one David?
Yes. Yes.
Good morning, all. It's David Lieutenant from New York. We're with Renegade Marketing. We're a market research firm. We're a venture center for Expert Dojo, and the side hustle is I source funding to startups through VCs and a couple of family offices. Thank you.
Oh, yeah, your audio broke up a little bit. Georgia.
Hiya, my name is Georgia. I'm the founder of a company called Zenova Animal Health. We develop antimicrobial medical devices that prevent infections and ultimately eliminate the need for antibiotics within veterinary care. Obviously super important considering antimicrobial resistance is alive and here. Yeah. And the first people to have animals to have antibiotics restricted will be companion animals. So that's what we're focusing on. I'm a first-time founder, so really just sort of trying to act like a sponge and absorb all the information I can.
Good thinking. Joseph Chen, how did I wait so long?
Because I spoke earlier. Yeah, I'm a New York Metro-based investor. I do real estate and early stage tech.
We'll have to have Joseph come back and speak again soon. Luna.
Yes, good morning, Bonnie. Thank you so much. I found you on Angel List. I'm with Corporate Invoices and Builder Invoices. We basically deal with B2B and mid-corporate age invoices and the whole recovery process. I'm also a litigation paralegal. So we're really on the front lines of understanding the problem of the real problem of accounts receivable, the realness of balance sheets. I also lived in the Bay Area for 10 years. I'm not a fan of VC per se. I mean, the valuation and the expectations was, really, I experienced Ron Conway and all of that. So I'm really on the front lines with that. So recently I attended the Rev4 conference, which was excellent with respect to AI and understanding the importance of AI. And so we're, my role in terms of VP and founder, I mean, we're sort of in the sort of six year plus stage now, but understanding the necessity of understanding AI, but AI in terms of the optimization of invoicing. Our invoicing system is a problem. So globally, worldwide, all of that. So that's what we tackle with on a day-to-day basis. Thank you for having me. I appreciate it.
Oh, thank you. Natasha, good to see you. It's been a while.
Good morning, everyone. Hi, Bonnie. How are you? My name is Natasha Norris Standard. I'm the CEO and founder of NNS LLC. My primary focus is manufacturing military-grade combat boots sized for the female foot. I spent 20 years in the United States Army. None of my boots were sized for me. We just received our first large purchase order from the U.S. Navy in the commercial version of our boot. So I'm super excited. I've been drinking from a fire hose since 2019, but for some reason I love it, and I'm glad to meet everyone on the call. Thank you.
I will say that Natasha spent 20 years jumping out of airplanes. Nothing's going to stop her. Nothing. Keenan.
Hey, how are you, Bonnie? Been a long time.
Good, how are you?
Super well. Hi, everyone. I'm Keenan Williams, the co-founder of Resi. We made it possible to rent apartments instantaneously. And then once we lease up those units, we take the cash flows and securitize them into a bond and sell it to the private investor market.
Thank you. Nicholas.
Hey, all. Good to meet you. Hi, Bonnie. I've been to some of your live events, but not it's first time on the web.
Oh, wow.
Come out of traditional corporate, which I don't like. Not necessarily a founder myself. Have a couple of small websites, a couple of ideas for things that I'm working on, and just wanted to get everybody's just kind of get back into the swing of what's happening here with VC and investing and founding. So glad to meet everybody, and I will follow you on LinkedIn if you've got it in the chat. Thanks.
Yusuf.
Morning, everyone. Bonnie, thank you. So a bit about me, I'm a product manager by occupation. Been working in the tech industry for about 8 years now, looking for new opportunities in US and Canada as well. And yeah, happy to be here. I want to learn more, want to see what's happening in the startup world, and yeah, it would be nice to connect with the others afterwards.
Elise.
Hi, everyone. Happy to be here. Elise Dunn calling in from New York City. I am the founder and CEO of Care Copilot, which is a marketplace of everything that you need when you're taking care of an older loved one.
Oh, thank you. Been there, done that. Did I get everybody? Because the names keep jumping around and I'd hate to have missed somebody.
My name is Evan. Did you get hold of me?
Oh, go ahead.
All righty. Hi, Evan.
Yes.
Here. Yeah, I'm the CEO of Vector Photonics, and we're developing an artificial intelligence light fixture. And we use its bird's eye view to detect what's going on in the room and automatically provide people in the room with their needs. It is very sustainable and very life-saving. So if somebody, let's say, has a heart attack or stroke, or an elder is being abused in a nursing home, we know about it. You can call 911. And if when you enter a room with an Alexa, you might be able to tell her to turn on the lights. When you leave, you're certainly going to forget. So we do this automatically. We monitor all the energy use and all the safety security that's going on in a home. automatically with AI. There's no need to ask. We've been at this for about 4 years. We received from the Israel Innovation Authority over $1 million, and we're seeking further investment.
Thank you.
Thank you.
Bonnie, I was driving, so I couldn't answer your call. So
okay.
Alex Vachon, good morning. I'm a filmmaker and a video creator. And basically, I built a career on creating in each and every video we make aha moment.
I always appreciate that. So Glenn, you're on. I know that there's so many topics you can discuss. And I know that you're in Silicon Valley and it's not quite what it used to be, is it? So you want to talk about that?
Yeah, I mean, I was just kind of lamenting, I guess, or thinking back. I mentioned before some of you joined that it's just a lot less density here than there was when I was living and working here. And I don't know if that's remote work or if that's migration or I'm not sure what it is, but as an example, for those of you that know the area, I drove from Santa Clara to almost all the way to Palo Alto yesterday on El Camino, and I did it in about 20 minutes, which is about what you could do in the early 2000s. But in 2016, that might have taken you 40 minutes, 45 minutes, because, you know, there'd be so much traffic and so much pedestrian traffic as well. So it's just a completely different vibe, which I thought was fascinating. You know, it's still a very energetic place. I'm not one of these. I don't think you have to be here. I think you have to be mindful as a founder. I think you know, I'll give it great, what I think is a good example. We've got a team in Cedar Rapids, Iowa, which focuses on the health of baby piglets. They wouldn't make much sense, frankly, in Silicon Valley, but the company's been incredibly successful. And the reason that they've been incredibly successful isn't necessarily even where they are, it's how much they've wrung the juice out of that market that they're in. So they went to Iowa State and they've worked with all the leading professors there, and they immersed themselves in the very small ecosystem that Iowa has for startups. And they were able to connect, which I think is really true in small markets. They were able to connect with every top exiting founder in that state. So if anybody exited for multiple billions in Iowa, they've sat down over coffee with them. Try doing that in California. Good luck. Obviously, there are a lot, but the best startup founders, you know, in terms of exits here, are not going to be accessible for the most part, even if you're running in the right circles. And so I think being in whatever market you can be in, you can still have an incredible mentor and advisory impact. Some markets, I think what separates this market that I've always thought, Bonnie, is that they're very good here. You know, when I was here too, they're very good. I was very frustrated when I went to Seattle, because in Seattle, my experience is that the founders who exit and the people who do really well in the ecosystem don't give back, not near as much as they do here. And I think that still happens quite a bit here. It's not like it used to be, but it still happens. I go to a lot of events at Stanford and a lot of events around the year for the ecosystem. And there's still a lot of that giving back, investing, mentoring, advising, and it's still a robust ecosystem. But I think, again, you can be anywhere, and it's not what it was. There's no question about it. Now, we pulled out of New York, so maybe for those of you, there's a lot of folks on this call in New York. I haven't been, you know, as active in New York as we used to be, as you know. And I thought that New York had a very good chance of giving the Bay Area a run for its money. And yeah, I know that all markets have dropped off a bit, but this market certainly has changed from when I was here. No question.
Well, a lot of the New York investors moved down to Florida. You know that they're all there and they're not going back.
All my family offices, all the ones that are invested in Quake, I think all but one, are basically relocated down there. Our whole team moved outside of New York.
Yeah.
So it's crazy. You know, I did want to mention on a couple, first of all, just a quick comment. I know there are a number of founders on this call who sent me materials or wanted to connect, and I'll do that. I've been traveling quite a bit. So I want to let them know that we got the materials. I also wanted to mention, I think I'm looking for names here and I'm trying to find it, was Dean and Luna are focused in that AI around invoicing and kind of the efficiency of billing is kind of my perception of that. And we've seen that there's a lot of really, I just wanted to quickly comment for the two of them that I've seen a lot of teams do really well. And I don't view that as negative. I mean, the field is green. The field is very large, so you can have multiple companies. But I saw a team I looked at last year, a year and a half ago, that was probably valued at about, it was, let me put it a different way. They were probably doing about $2 million in revenue. And in a year and a half, they're up to 100 million in revenue. And that was more in Dean's area in the healthcare invoicing or efficiency. And I just think that's a fascinating area. That does seem to be a lot of movement there. So I want to comment on that. And then Keenan, if you're not already talking to Who's Your Landlord, I don't know if you happen to know those folks, but Ofo's a entrepreneur in residence here at Quake, and yeah, I think there's definitely some synergy. And what you guys do totally different businesses, but I think there sounded to me like there's probably some synergy there. So I'd love.
Yeah, he's actually a really good friend. We were in Alley NYC co-working space back in 2016.
Okay, great. So there's nothing to do there. All right, great. I just feel like that as you were describing it, I'm like, okay, yeah, you guys should be co-selling some stuff there. There seems to be some opportunities. So, okay, that's great to know. So apologies about that, Bonnie. I just immediately saw some interesting stuff there. And obviously I love entrepreneurship. So all the deals always sound great to me. Yeah, what would be, somebody wanted to talk, I think it was Joseph brought up earlier before some other folks were on the call, about artificial intelligence.
Yep.
Would it be helpful? I don't want to revisit because obviously I just went off to the races on that conversation, but would it be helpful to get into some of that again, and then maybe go a little deeper?
Anybody?
Yeah, so
go ahead.
Yeah, I think what I was saying at the time when we started was that we're seeing, one of the things, you got to rise above the noise. There's an awful lot, and there's several entrepreneurs on here who aren't in AI, so I don't want to get too hung up on it. But for those of you in AI, it's a buzzword right now, and it's not a new technology. For those that have been in, I mean, obviously there's some new iterations, but for those of us that have been doing this a long time, this technology, as in its general sense, has been around 50 plus years. So when I see a startup founder that puts a deck in front of us that is really promoting AI, and oftentimes I mentioned again before many of you were on, I had a founder tell me they were the first company to do something in AI, and I was doing the same industry with AI 20 years earlier. So I think you got to be careful about throwing around buzzwords, but obviously AI is a transformative technology. There's very little getting around the fact that it's definitely has the ability to impact efficiency. But I think you just want to be careful how you go about it. And what I was saying earlier, when we invest in AI, we look for really specific we do this for all things. Okay, so AI is not unique in this regard. It's just, I think you just want to use the same kind of standards, whether you're talking about the new hot thing or whether you're talking about the old and tired thing. We look for defensible moats around aspects of the business. We want to know that the business can separate itself and provide unique value that somebody will eventually pay for. That's how you exit. And I could get into a lot about that, because I think one of the things I underestimated as an investor was exiting always came really easy to me, and it's obviously really hard for a lot of founders. Well, one of the ways that you get to an exit is you create a really defensible business. And so a lot of the things that I see in AI, and I think Joe Chan was talking about this a little bit, is that they're leveraging somebody else's platform. And that can be okay if you've got multiple platforms. I'm not an API hater. Like, I don't mind application programming interfaces as a thing. I just don't like when somebody builds their entire business on Facebook or on LinkedIn or on ChatGPT or OpenAI, let's say. I don't want your entire business built around one company's view of the world, because that company might do something stupid. They might decide they want to go a different direction. They might decide they want to monetize your access in a way that makes your business model really uncomfortable. So there are a lot of reasons why I don't love that type of business. I want to have a really defensible moat. One of the areas that I think you can do that, and I'll do this a lot. I'll use one of our companies as an example. We invested in a company out of Israel called VoiceIt, I think 6 years ago now. It was one of our first investments. And VoiceIt takes indecipherable speech, typically, neurological trauma, might be a palsy, could be severe autism, but a lot of people can speak, but other humans have trouble understanding them. But the sound wave is the same consistently. So the computer, once it knows what that sound wave represents, it doesn't have any problem understanding and can decipher in real time. So the defensible piece of that business is the training data and collection specifically of the training data. They know that you have to have clean data that you know is verified. So building a system in that company that could collect that data, because otherwise Google could do this. Google gets tons of, Zoom could do this. There are loads of companies that collect lots of audio of people talking. Amazon, certainly, right? By the way, I should mention that that 2 of the 3 names I just mentioned are investors in VoiceIt for the very reason that it's defensible and difficult for them to do. Google can't do what they do. Amazon can't do what they do, because to do it, they had to go get 9,000 speech therapists and collect a corpus of data that was heavily vetted by professionals. And that's not something that those companies necessarily want to do. They'd much rather just buy it. That's what I'm talking about when I mention like a defensible thing that somebody else will buy. They'll let you go and beat your head against the wall for 6 years, 7 years, building that defensible piece that would be hard for them. It would cost them a ton. It wouldn't look particularly good on their balance sheet. And then they'll just buy you. And so that's more the types of businesses that we're focused on. So when we talk about AI, that's exactly the types of things that we're looking for in that space. And I think as a founder, if you're working in those areas, you want to think about not necessarily just the gee whiz factor, but what is it about your use of AI? And I mentioned Luna and Dean earlier. There's a lot of, those are examples where you're going to get access. I'll call those Trojan horse, and they may not like me saying that, but we got a number of deals in AI that I would refer to as kind of Trojan horse deals, where almost like Facebook, the customer, you become in Facebook, you're the product, right? The customer in many of these AI deals becomes the product, because they're actually giving them all their vetted data, which they could not, these startups couldn't otherwise get. They're paying them to give it to them. And then the startup is turning that into a monetized, value laden component inside their business. So those are the things that we look for. That's what I would be doing if I was doing, I'm glad I haven't been doing startups the last few years as a founder, because it's been a crazy time. But if I was, those are the types of deals that I do. And if I was playing in AI, that's what I'd be doing.
Any questions? Anybody want to comment or ask a totally unrelated question or focus on something else?
I actually really like the comment. I've never heard of investors say it, so it kind of took me back. You said exits, come easily to you, and it's based on you building from a central thesis of highly defensible moats. If you know it's highly defensible, it's definitively going to be attractive. I guess to take that comment a step further, when did you know the timing was right, and how did you find that partner? Or did you leverage like a Jefferies bank or some broker to always kind of bring deals or buyers?
That's a great question. One I haven't thought of myself too much. I have given this some thought, and what I've recognized, and every founder on here that's done multiples will appreciate. No matter how good you are, no matter how formulaic you are, every startup you do, it's like a new organism, right? So they're all different, and the same what I thought would work the first time wasn't necessarily the next time. More often than not, the way I kind of described it to people around me and my teams was trying to be an obstacle in the road for the right set of buyers, understanding where the industry was going and understanding who the big likely acquiring teams were in my marketplace. So if I was, if I was going after ag tech, or if I was going after prop tech, or whatever sector I was in, I would identify probably the top 15, 20 targets that were doing roll-ups or buyouts and acquisitions. And I would really scrutinize as a leader. Now, remember, this isn't at the very earliest stage of my startup. This is probably 2 years in. I've figured out product market fit. I'm making good revenue. I'm probably easily could get to cash flow break even. Some of you are going 2 years in. Well, the world's changed since I was a founder. It's a little bit different, maybe 5 years in now. So, but in any event, I would look at, once I got to the point that I could take a breath, I would really get strategic about the people in my industry that were likely to take us out. And I would try to be an obstacle in the road. And I would usually do that with, when I had the benefit, Keenan, of being a guy who did both private, real early stage, and public, pretty big, like 20,000 shareholder big. So not crazy, but good size public company. And from that process, from running a public company, I kind of understood how analysts and how my shareholders would react to me spending my R&D budget versus just going out and buying something. R&D budget is painful. It basically affects my operating budgets and margins in real time, and affects the value of my company. Sometimes you want to see that. Companies like Apple, you want to see large percentages dedicated to R&D. That's how they're going to move forward. But when you're a smaller public company, those things can be painful, versus an acquisition, which I can explain to an analyst is going to be accretive, is going to be positive from day one. That will actually move my stock up the moment I make the purchase. So instead of being an anchor on my stock, it's going to be a positive on my stock. So if you understand the mechanics of that, you can start to play that game when you talk to bankers, when you talk to large brands that are going to buy. So it's a variety of things. To answer your question, I've had situations where I've gone out and said, look, I want to sell and I don't know who to sell to, and I think we're mature enough. And we went and interviewed bankers and we hired somebody. I've had situations where bankers have come to us because they already knew who the buyers were, and they were specifically looking for what I just described, something that would be immediately accretive that they could pitch to analysts that would drive the stock up. Bankers are really good at making those arguments. And then the third, obviously, is that, a lot of times you can bring in, and we've done this with a lot of our teams. The team I mentioned in Cedar Rapids earlier today, they've got, they're in the pig space, right? They've got investments from Johnsonville Farms, Smithfield, the biggest pig producer in the world, Boehringer Ingelheim. Those are all, and they've already had 4 acquisition offers from a variety of different companies. But those are all investors who are also potential acquirers. So you can get real strategic about how you bring in as you start looking at corporate VCs. But the one quick comment I would make there is just be really careful as you do that, not to put a poison pill in your deal. Don't do a deal that will scare off other potential acquirers or other corporate VC. So you definitely want to be cautious when you do, a corporate VC deal that could eventually become an acquirer and competes with other potential acquirers. You have to be careful about that. And we've had to advise, there have been cases where we've advised startups not to take that capital, but that's a really good migration path. You probably won't get as much in the exit from my experience if it's an existing investor who becomes, because they know, to be blunt, they know too much about your business. You can't snow them at all about the value. They know specifically what you're worth and what they're worth. So I would just say I would probably play those different angles and just be cautious a little bit if you do the strategic investor one.
Completely agree. Thank you so much for that.
Glenn, could you tell us a bit about what are the categories, the types of products that you're looking for? We're in the B2B SaaS. future of work, productivity types of areas? Are those types of things you're looking for, interested in?
Yeah, so we made a decision. We're generalist, right? We have a few things we don't do. But we're generalists for a reason. There's plenty of VCs that go a different route. I don't have any heartburn over that. We believe diversification was a huge, that was very important, and it's proven out for us over the last few years. We've done incredibly well, and I've seen a lot of other funds really struggle because the last few years, certain markets have just gotten decimated. A lot of them that were very hot. We tend to look for deals. B2B SaaS, certainly an area we plan, just straight up, to talk about that one. But we tend to look for things that have obviously a lot of the same buzzwords other VCs use, but they use them for good reason. So I mentioned earlier, defensible moats, large markets would be another one. Obviously, repeatable models, repeatable sales models is important. We're not as focused on high margins. I know that's hugely popular, but there are two ways to attack that. One is low margin, basically high yield, like a lot of deals, a lot of transactions rather. Another is to go higher margin, and it's not always. I've built very successful companies both ways, so I'm not biased about that. So we're not as hung on that. Obviously, SaaS pulls great margins, but we've got a lot of deals that are, that we invested $3 million that are now worth close to 100 million with lower margins. So I don't get hung up. Now the exits aren't as good. By the way, there's another thing on exits for the founders on the call. I'll come back to it later if anybody wants to talk about it, but how much you hold in your company completely changes the answer I gave to Keenan earlier. It's the more you hold. And a lot of the teams that we have with lower margin businesses, the reason I bring this up is somebody else, I think it was Luna, mentioned about challenges with VC. A lot of VCs have impacted the market in a negative way over the last few years. They're what we would call, and I think it's an offensive comment, I don't mean it to be, I'm just using a term people have heard, but tourist VCs, these VCs that maybe have too much money and think they can kind of engineer an outcome with a lot of money, but they create really negative impact in the ecosystem because they drive valuations artificially high. Almost all those deals are around high margin areas. So they're pouring money into those. Valuations shot up. A lot of VCs focus there. But if you look at the founders that are in those high margin industries, they tend to also own less of their companies because even though they're getting great valuations, they're also raising a ton through in many cases, they're not bootstrapping as much. They're having better access to capital. They're raising more capital. They're diluting. There's nothing wrong with that. I'm not trying to pass a judgment there. I'm just saying if you look at it statistically, a lot of the lower margin teams, at least in our portfolio, and it's a big portfolio, those founders own more because they had to bootstrap further, they had less access to capital. And so what ends up happening is really fascinating is when you get, and I'll get back to your question, I apologize, Stuart, but just wanted to get this off my chest. When you get out to the exits, you see that these teams that are selling for 100 million, the founder's making as much money as somebody selling for $1 billion. And so it dramatically changes their view about when they exit, how they exit, what they're willing to take, what their walkaway number is. It's just fascinating to me to see that dynamic. But that's so far away from your question to answer. We do almost everything. The only things that we don't do, if it's, like real deep biotech, we're not going to play there because we don't have the expertise. And in most fields, we can go bring in the expertise, but that's when we don't. If it's a really long sales cycle, which generally for me, one of the worst, and I love the space, but we just don't do much there because of this. And I bump into a lot of great founders here, so it's frustrating. But EdTech is one where we don't do a lot. I think there's a lot of need for it. I think there's a lot of good stuff out there. Where we get an exception to that is where you have something like voice that can be used in EdTech, but can also, by the way, they're doing let's just say they're doing a plugin for this type of conferencing we're on right now. They're doing with a couple of the biggest companies in the space that'll work in real time so that people with a speech disability can get on a call like this. They can communicate in real time. And I'm talking about situations where these people just, they literally cannot get on this type of call because they don't have, nobody could understand. So that's an example where they built that for ed tech. You would think a lot of the early work they did was ed tech, but they figured out how to monetize and commercialize in a way that they could get to market without a 18 month sales cycle. So anything that's going to have a long sales cycle. We've got 3 FDA deals in our portfolio. I just said we don't do biotech, but we've got 3 FDA deals in our portfolio. FDA is another one that takes a long time to clear, but we knew that these deals were already through most of the work that they would typically go through to get the FDA clearance. So if we can validate that, or if we can talk to a customer that can tell us that it's, even though it looks like a long sales cycle, it's close. But again, generalists. So we do, I would say if you were describing us, we focus on things that family offices like. So then that's largely because when I launched the fund, I launched it in the conversation with several other family offices at a family office conference. I mean, when I say launched it, when the idea came around. And so we've got about 80, give or take, family offices that invested in the funds. And so we focus on agriculture, infrastructure, logistics, transportation, manufacturing, any of the areas that are kind of these old mainline business industries with lots of buyers, customers and acquirers that are maybe ripe for disruption. And we'll bring in, modern technologies, machine learning, computer vision, AI that I mentioned earlier. Those types of things coming into some of these markets can be highly disruptive. That's what we look for. Typically, that's what we look for.
You invest in consumer products as well.
Oh yeah, we did. And the exit we just had was, I said I'd never do food tech. And when I say food tech, I don't even mean food tech. I'm just talking like CPG, but food, right? So the exit we just had was a real nice 10% return on the fund, 10% on the principal of the fund, which is a really solid exit on a food deal. So yeah, we'll do CPG, we'll do food. It's not our wheelhouse. We typically like to do that. And I think this is interesting when you guys are the founders on the call, and actually some of the, the others who are on the call who are on the finance side. We tend to like to partner on deals like that when we can with somebody smarter, right? So we might find the deal. A lot of times we don't, but if we find the deal and we really like the founders or we like the story, the differentiator I mentioned earlier, we'll go try and find an expert from our network that invests money, somebody who's actually, got capacity, and we'll try and partner with them, almost a syndicate. And if you can do that, that's a really winning from up where I sit, right? That's a really winning way to do this, because now we got a partner who can bring other people to the table.
Hi, Glenn. I have a question. This is Natasha. As far as consumer product goods and manufacturing and like the new U.S. manufacturing initiatives, where do you think the future of that is going? Is it going to increase manufacturing in the United States and pull the manufacturing from China? Because right now I have manufacturers in China, India, and Mexico, and I would love to have only my manufacturing here in the United States.
Yeah, that's a great question. We saw, so a lot of our teams, there was a really rapid shift, as you're talking about. There's a really rapid shift during COVID. We had a lot of teams who've now shifted to the US and Mexico. Mexico is the primary, I would say, that a lot of our teams that are trying to really build, again, I'm going to use that term defensible, but it's probably a little bit different use here, but they got punched in the gut during COVID. Usually it would be like, and it may be a little bit different for you and your product, given your description earlier, but in their case, it was like one component. So it was companies that had 20 components coming together to build their main product. Oftentimes it was actually assembled here in the United States, but that one component coming from China was unobtainium. And that was incredibly frustrating. Deals were lost, revenue was crushed. So those companies, almost all of those, moved their manufacturing to the US or to Mexico. There are some that moved to Taiwan, Thailand, Vietnam, a variety of places, right? But I think you still are subject to it's not even just what's going on in those countries. A lot of it in that particular instance was just movement of product, right? And so I think, yeah, we've definitely already seeing that shift. And I think it is going to I don't see that stopping. I think that certainly, maybe there's another wave of young entrepreneurs who come in who haven't been burned yet and open that up. But I think a lot of the, again, looking at our portfolio, almost nothing that has a critical component is built in China now.
Oh, wow.
Almost nothing. I mean, I'm not saying there's not product, but they have a secondary source. If it's a singular source product, or component, it's not coming from China on any of our teams.
I understand. Thank you.
I have a question if I can jump right in, if that's okay.
Sure.
Thank you so much. Really, really appreciate it. So Glenn, thank you for your feedback in terms of the importance of a good term sheet and the entrepreneurs not being, really kind of looking at understanding, their dilution and so forth. So, but I wanted to get back to your question, to your comment with respect to a business must be defensible, right? So right now, we are in the process of engaging a data scientist, right? So for a company that is not technical, trying to engage a data scientist, that presents its own challenges, but we're stepping in there. So the data scientist, speaks about the first part is a data ingestion and storage, right? And then sort of business being able to have ownership of that, you mentioned, be defensible in the monetization. So and to create sort of a situation where you have control in monetization. So you've got your Apples and Facebooks, they've got, obviously, the major platforms, but then you have a newer player, which is Databricks, right? So they just acquired, I think, for over 30 billion another company. So the question is that how does a business do that, right? So, without having that sort of scale and that, so our data scientist says, okay, well, we're going to do this data ingestion and storage, but we have to put it over AWS. And then the ML side, we might need to work with a Databricks that has some products. So the question is that how do we, how does a business deal with that defensibility when you have so many other companies that you have to sort of still layer over their platforms and still have some control over what?
That's a great question. There are going to be some examples. That's a really good point, Luna. There are some examples where aspects of your business are almost impossible to architect away from. But I will say this: I run in some. I think IRC, right? The old school Slack. And I'm in some IRC channels with some old timers, and we kind of have humorous moments where we see meltdowns. Everything's in the cloud, and nobody has a backup plan. So when certain things happen, and AWS goes down, which can't happen but does, very rarely, but does, then bad things can happen to small teams. And I'm not laughing about that. I'm just saying that, again, much like I was talking about manufacturing, part of the job is having contingencies. But you're right, there are certain aspects of the business, I would argue that, even with Microsoft and Google and Amazon being three options, cloud infrastructure is an area that's kind of hard to architect around. I would argue that in many cases you should, but nonetheless, there are certain aspects of business where you are stuck, especially as a small company, and especially on a constrained resource, constrained budget. I think as you scale, you start to think more about those contingencies and those backup plans than you can at the beginning. At the beginning, they were joking about Natasha jumping out of airplanes. At the beginning, you just jump. And you don't really, there's not a whole lot of choice. You're just going to have to go against the wind and take some risk. And then as you start to get, really, I think a turning point for every company, I know it's overplayed hand, everybody talks about it, but that product market fit, that's not just important to discover that you've actually got a viable business that can go somewhere. By the way, we, going back to Stuart's question, we invest. That's a big key for us. I'm a data scientist by background. That's where I play. And So when we invest, we're looking for proof of product market fit. We're not MVP, we're not ideation. We are in market with revenue, sometimes not revenue, but other forms of traction. But we're looking for proof of product market fit. But that moment in your company, there's two key moments. That moment is the moment that you get a lot more strategic. You don't even know what the heck your strategy should be. You know, most companies build a product, they think they know how their customer is going to use it. I would say realistically, 7 out of 10 times the customers don't even use it the way you expected, as smart as you thought you were. If you're that lucky, I mean, you're the 1 in 1,000. I mean, literally, I looked at 1,000 startups. I've looked at more than that, but I looked at 1,000 unicorns are close before I launched Quake, and there was only one I found that had just nailed product market fit from the get-go, and the rest of them just lucked into it. And so, and even that one would be questionable, I would say. But regardless, I think that when you get to that moment, pardon me, I just completely tore my mic out. But when you get to that moment where you've got product market fit, now you know how the customer uses the product. Now you can actually build strategy. Before that, you're just fumbling around. The second most important, I actually think the most important day in your company is when you can get to, and there's loads of VCs that will hate this comment because they're all about scale, scale, scale. But I'm a founder. And the day that I got to either cash flow break even or recognition on the real balance sheet, the real projections, not the ones that we give to the VCs, but the ones that I look at right before I go to bed every night. And then I'm not saying you got 2 sets of books, but I'm saying you absolutely know when you know that you can get to cash flow break even. That's like a transformative day in the life of a founder, because you now have complete control of your destiny. There's a lot of interesting things that you can do in funding, in not funding, in other types of funding, in acquisitions of your own. There's lots of stuff you can do that you couldn't do before. So for me, that's obviously those are big, but I would say just in terms of kind of the way that the market looks at this stuff, they probably totally disagree with most of what I just said. The way the other VCs look at it, probably.
Thank you. Thank you so much. Glenn,
you mentioned in your early remarks that most venture data is bad. Can you?
Oh, it's horribly bad. Yeah, I mean, and there's tons of proof.
Why is that? Why is it so bad?
That's a lot of, it's like selection bias, running in certain circles. I mean, one thing I'll say is that this is true. One of the tools that you use in venture, and there's a number of venture people on here and investors on here, one of the tools you actually do use is pattern recognition and pattern matching. Guess what? It's like human AI, right? And that's certainly a viable tool, something we all use. And so I think problematically, we think we can apply that necessarily to that because this team looks this way, that we can apply that same, to all the different metrics. The founder is of this age, they're of this gender, they're of this background, they went to this school, they lived in this community. So I think there's just a natural tend to try and apply the same things we apply at the company level to the underlying core data, like the pre-data level. It just doesn't work. While the data supports pattern matching inside what works in a company, more often than not, it doesn't support that for the precursors that take you there. So again, I always tell, it's fascinating to me that the biggest data set, we can argue whether it's clean or dirty, but the biggest data set every year is Startup Genome Report. I'm not paid to promote them. They just look at more than anybody else. At least they publish it. There are loads of others that actually look at more, but you and I can't necessarily get to it, even if we pay. And so if you want to be able to get to a big data set that you can actually review, they have one of the biggest ones out there. And I would say maybe a third of the VCs I talk to even look at it, which is astounding, right? And even fewer startups do, which is even worse, because primarily what that report does on an annual basis is tell you why companies fail. And yeah, I kind of wanted to know that when I was running startups. So I was reading it, you know, there's two tools I've used. Well, as soon as I found Startup Genome, I started using it as a founder. And the other one I used was, I don't have time. I read, I'm a voracious reader, and it's getting harder as I get old, by the way, but harder as I get older. But I used, and there are other tools out there, so I'm not promoting this one, but I used SoundView or summaries.com, summary.com, I can't remember what it is, but SoundView books summaries I used for dating back to probably 1999, because it allowed me to read summaries on, you know, anywhere from 10 to 20 business books a month. And then if I saw something that looked really compelling, I would buy the book and drill in deeper. The same thing is sort of true on the data side. Startup Genome Report just gives you a, rather than having to go to 100 different places to pull down data, you can go to one source, you can get a lot of information. Highly recommend it.
Thanks. Yeah.
I have to do a breakfast with you and Joe Milan both on the platform because he has his angel spin, and you two are so on the same page on all this. And I know you know each other.
Yeah, and I, you know, it's funny, as I talk to a lot of people in the space, you will see a lot of similar, you'll come across a lot of similar, again, patterns, right? So it's kind of funny.
Next question. Because before the call started, you were talking about what I'll call the Series A conundrum.
Oh man, that's such a big issue right now.
Yeah.
I'm so glad that you went back to that, Bonnie. I don't know how many people were on or heard it, but so this is like, maybe it's more for the founders on the call. And, you know, for those that were on, I apologize, I'll go through it again, but there's this situation going on right now. First of all, one of the things that's happening is a lot of funds are trying to look, and I'll tell you right where we are. We're in between Fund 3 and Fund 4. So we've got a high confidence fund that's deploying capital. We've got a really small amount left in Fund 3, but we're basically ramping up and raising for Fund 4, which will come out in the fall or the early winter. But a lot of funds are trying to appear like they're deploying capital right now. And there are some that are deploying capital, but the vast majority of capital that's getting deployed right now by established funds is really going back into their deals. You know, we still did in Fund 3, I think we did this year, we did a lot less than normal, but I think we did about 12, maybe as many as 15. I know we did at least a dozen since January to now, which normally we do probably close to double that. And in some years even more. I think our high water mark on a year was 70, or yeah, around 75. And but so we've slowed as well. But I think a lot of funds are actually not deploying at all in new capital, and they're shoring up old investments. But particularly, they're shoring up, if they're a larger fund, they're shoring up their later stage stuff. It's harder for one, you know, it's those valuations got hit harder. They need more capital. They've built to a certain point, business is slowed, but they have a substantial burn rate. So it takes a lot more money, and raising a lot of money in this environment is tough. So there's a lot of good reason to pour back into those deals. But what's happening is, if they're in a, particularly if you were a founder who took money from one of these big, I'm talking big funds, right? Big name funds, typically names that play post A or maybe in A. But some of those funds will do, like, I'll just use an example, and I'm not saying these are good people. I'm not using them as an example of one of the funds that's kind of screwing people over. But Bessemer writes checks from 25,000 to 25 million. That's not a joke. Like, I've seen them do it. And it's not just, you know, some phrase. And I would say that funds that come in and do early stage, that are mostly in the later stage right now, those funds that we see that came in on a late seed deal, they're really, when they don't come back in on the A, optically, that's not very good. So as a founder, you have to be very careful. Is this going to be a good partner for me? Are they going to come in and support me in the next round? And obviously, they might want you to hit certain milestones. But if you do, will they be there for you? Because if not, We got a huge fund out of LA that's not doing a follow-on in one of our deals because they got just destroyed over the last 2 years. And it really looks bad. I mean, that's such a bad signal to have a big name like that on your cap table, and every single fund goes, well, are they doing? What are they doing? And you say, I have to say no. And then you have to explain that their business is bad, and that doesn't work. So right now we've got a lot of situations, and I'm in the Bay Area today specifically to go meet with a bunch of big name funds that are in one of our late seed deals that is raising an A, has interest in the A, but these guys aren't coming in, and optically it's hurting them. And they're not coming in because they're doing their C's and their D's. And there's just a ton of that going on right now. And I think the other thing that's going on is that a lot of funds are just to be blunt, they're bullshitting. They're not really deploying new capital. They're deploying old capital. They're deploying new capital in old companies. And we're doing a ton of that too. We're doing more than we normally do. A little more triage than normal, but also a little more defensive, not just triage. Like, we know it's a good deal. We like it as a deal. We already know the company well. We knew they could survive. They got through a really hard time. So there's a lot of smart, there's a lot of smarts in applying that capital there versus in something new and unknown. I get it. But just be aware, there's a lot of talk about, yes, we're deploying capital. And, we deployed 15 million last quarter, or 25 million, or 200 million, or whatever it is. But maybe that was all deployed in portfolio. So just something for founders to be aware of.
Thank you. Somebody else had a question. Oh, Joseph, you had your hand raised.
Yeah, I gotta have at least one question a week. Glenn, I'd love to hear your thoughts about what you and your fund look for in the actual founders and executive team in the companies you invest in. Because I know that's
Sam probably won't appreciate this, but in the beginning,
Sam, close yours.
I really when we were first getting started in Quake, I discounted the value. Apologies to say this, I was a founder, coming as a founder point of view, but I discounted the data scientists in me had looked at the data and determined that you could come from anywhere, just like I just said, all this different stuff. But the relationship is incredibly important. So what I look for more than anything, actually, I'm really glad you asked this, Joseph. I just had a call yesterday with about 5 of our founders, and I was talking to them about things founders don't do that I wish they did, and they don't understand. Transparency, that's number one. Like transparency, honesty, credibility, like that, whatever, those are different things, but along the same related spectrum. It becomes so ridiculously important that I'm going to have ongoing communication with my founders. And I didn't necessarily think of that in the beginning. And the reason it's important is I have a job to do. I have to report to 80 family offices, or, I've got a couple foundations. I got a bunch of different investors. And who do you think I'm talking about? I was talking to these founders about it. Like, I've got founders who never send me, even though we've got investor rights and everything, there are some founders that I don't hear from. Maybe I hear from every few months. If I reach out to them, obviously they respond. And I've got founders who communicate with me certainly every month, and some of them even almost weekly. Which ones do you think I'm talking about? Which ones do you think I promote?
The weekly guys.
Yeah, because I'm going to get burned talking about the ones I don't know about. So I'm not telling other people with money about any of the deals that I'm not hearing about. So if a founder only reaches, and by the way, this applies even to those that I'm not invested in. So I've got founders that keep me in a distribution. That's incredibly important. It tells me a lot about, this goes to your question, Joe. It tells them a lot. It tells me a lot about how that founder will interact with me as an investor, right? So I start to build an understanding of their pacing, their tempo, their communication, right? But as a person with a job, which I didn't really intend to go back to work, but I'm now working for a lot of people that had, much like I have family offices that invest in me, I have a family office, an active one. So much like I'm a pain in the ass for the fund managers that I invest in, they're a pain in the ass to me. They don't treat me any different. They don't treat me special. I'm responsible to give them updates. So those companies that are communicating with me are much more likely to have good chances of raising money next round because everybody that I talk to with money knows who they are. And we send our newsletter to 2,500 people. Funds are, so about 100 investors of ours, about 300 to 350 co-investors of ours. And then we have 2,500 total in our newsletter distribution. Almost all of those are investors and funds. You want to be in that newsletter. And that's, I'm not bragging about our newsletter. I'm saying that like whoever you're invested with has a newsletter. Get on it. And you get on it by communicating.
I'll plug
so
Bonnie.
say,
I'll plug Bonnie. She's got a newsletter. She offers it up all. She offers everyone a chance to be in there.
That's what I was saying.
It's crazy. It's like a huge value, right? So I just don't understand why. That's what I was talking about, that startup in Cedar Rapids, like wringing the juice out of their market. That's where founders miss. You don't have to be in Silicon Valley. You have to take full advantage of every opportunity. Like you just said, Joseph, the Bonnie's newsletter is a perfect example. So like to your specific question, that's it in a nutshell. Like communication, transparency, pacing, you know, just how often are we going to interact so that I don't look like an idiot, so that I have good information. You know, I'm doing triage on a deal right now. It's a good company. I like it. It's in a real bad problem, real bad state. Had they contacted, I will fix it, but had they contacted me 3 months ago, there would be no problem. We would have solved the problem. But instead they waited, you know, they, rather than bringing us bad news, they brought us worse news. So I just want founders that view us as a partner and can, and I know there's look, I understand that a lot of times when you're transparent with bad news with an investor, they might not give you more money. But you know what? That was more of a sourcing problem. And sometimes maybe you don't have any choices. That's the one you had to take. It was the only money out there. But that's more of a sourcing problem. That's, you've got a bad partnership.
There's also ego there, right? The founder has, you know, they don't want to
Sure.
admit that they made a mistake or that they're having trouble.
There's an embarrassment there too. I mean, in this case, I totally get it, but I sure wish that it would have been an easy solution, something we could have solved very easy. And now I've literally had to I've had to pay to bring in other people that used to do turnarounds with me to try and fix it. And that really should never have happened.
Oh, I wanted to give Zarin a chance to introduce herself because she couldn't earlier.
Yes, I was in a bit of a loud space, so yeah, sorry for that. I'm Zarin, based in Switzerland, in Zurich. I have a banking background, and currently I work with a few companies for strategic partnerships and business development, mainly in the areas of asset management and e-commerce. And regarding this funding question, I had one question. Many of the investors also could not take their money out, either from VC or even from regular markets, because if they did that, that would be realizing a loss. So even if they wanted to invest, there was a period of a bit of a freeze or a longer cycle. So how do you see that? Is it opening a bit, like do VCs return money, or still no?
Oh, that's a good comment. It's definitely worries everybody in the space, right? It's on all our minds. The last few years have been really weak. Last year was one of the worst on record, frankly. I had the stats up yesterday and I just didn't pay close enough attention to memorize them, but I do recall it was like the worst that we've seen in over a decade. I would say right now that we've certainly seen a thawing going on, but it's in a very specific way. I think that we've seen a shift away from typical M&A activity and more private equity over the last 6 months. And I think that that's probably a little bit of a head fake. I think that's probably a false narrative, because a lot of the things that we're seeing and you know, don't get Bonnie started or me, either one, but I think there's a lot of things in the markets right now, particularly commercial real estate, is worrisome, and that's going to have a cascade effect in private equity. It's a massive impact in private equity. So I'm telling my startups largely not to bank on private equity exits over the next year to 18 months. I think that's I think if you've got roll-ups that are happening now and you're engaged in conversations, or you can get something done by end of year, great. But I think next year is going to be a disaster for private equity type deals and roll-ups. I do think that with some of the valuation adjustments, it's been predominantly corporate M&A that's been really, really down. And I do think that that's going to pick up. I think that we're seeing, yeah, and the reason I'm saying that is not just sort of, it's not even based on necessarily outside data. It's based on my own portfolio. So the fact that we've got 280 startups and I'm seeing how much, we've got about almost 30, I don't have the exact number, but around 25 of them that are in M&A conversations right now with mostly corporate M&A, tells me that there's a shift going on, because if you had asked me last year, that number was about 11. So it's a big, and the 11 was, a lot of that was just investigatory. It wasn't really going anywhere. So a lot of these are real serious. So I do think that that's improving. So that's the first thing. And I do see a lot of funds that are trying to structure now with other ways of offsetting that dilemma. We didn't, because our structure is old and was developed in 2017, but we're thinking about it with Fund 4. So dividends and a lot of these other things that you're seeing funds do now to try and give some kind of opportunity. What we do, I mean, again, everybody's got their thing. We've still got exits happening, and we just dole out the capital. We don't ever reinvest or do any of that. So we just dole it out as soon as we get it. And we were very fortunate to have some early exits in, well, most of our funds. One of them, no, but we had the first fund we launched, we had 3 exits in the first 9 months. So that bought us some time.
Well, thank you for the answer. Yeah, that's been a pain point.
Yeah, and I wish I had a better answer. I still think venture, if you look at like the biggest, again, I'm not a hunter of unicorns, but if you look at the big unicorns for guidance and their exits, clearly early stage, early to mid, but certainly early stage venture is the lion's share of the yield. You know, I think in Uber, it was like 40% in the seed stage, it was like 40% of the ultimate yield. So a lot of that has to do with structure. I see a lot of angels and other early funds, without throwing stones, that's not my intent, but I see a lot of poorly structured deals. We were just in a deal recently, and there's 2 sides to this argument. So founders go one way, funds go the other. Post-money safes are way better for investors, and the world is arguing they're better for founders. I don't agree with that, but that's another conversation. Pre-money safes are far worse. We're in a deal where there were probably 25 pre-money safe investors and us with a post-money safe. We did about 4 times better on the follow round than they did. So structure is hugely important, and but obviously it's still where the yield is. My point being that I still think venture is where it's at. I don't think that's changed. We've just delayed. There's no question that we took a hit with COVID and then the lockdowns and companies. But with all the corporate profits on the stock side, I think that's why we're seeing such a heavy shift now to why we're seeing so much action in our portfolio for acquisition.
Thank you.
As a follow-up, thank you for that. Could you maybe talk a little bit more about convertible notes fees as compared to safes, and also the safes that have a cap, a val cap, versus those that don't, right? Because there's some nuance around that, and it's been said that historically, companies that have had an early valuation cap have traditionally done better, but I'm not sure what goes into that, and I'm wondering what you're seeing.
Yeah, I think so. I dug into that data. It's funny you bring that up, because I looked into that a couple of years back, because I saw some of those trends you're talking about, and I think what we were seeing, I can't be sure of this, but I think one of the things I thought when looking at the ValCap issue was that you had a lot of more sophisticated investors coming in with the ValCap. And so that was driving success, because, you know, the investors are hugely important to or it can be. Wrong investors are hugely important to the failure of a company. Right investors are hugely important to the success of a company, you know, their networks, their ability to provide follow-on capital, et cetera. So one of the things that happened when you started seeing ValCaps being proposed, they started becoming really popular with a lot of the big brands, early stage brands. So Y Combinator, 500 startups, a lot of the accelerators, some of the early funds, you know, Amplify, some others. So you really saw that a lot of the, I don't really love the term smart money because it implies something about other money. But I think that when you see a lot of these funds that have a lot of experience, big networks, follow-on checks, doing those kind of deals, it's going to influence outcomes. So I think that's a lot of what we saw with the ValCap. The other thing that I saw with the ValCap that was interesting is those deals tended to be much more structured in terms. So Paul Graham figured out something. He didn't figure it out. There's a lot of us who talked about it. I'm not taking credit for it either. This is just sort of like Mark Andreessen taking credit for product market fit. That's something that's been talked about as long as I've been a founder, and I was there before Netscape existed. So, I mean, that's not to be a jerk. That's just reality. There's a lot of these terms that float around. So I think when you look at how much money you give to a startup, Paul Graham figured out that if you give a startup, you know, much more than $500,000 in the very beginning in their seed stage, that they're going to make a lot of really bad decisions because they, and apologies to the founders on here, all of whom want more than $500,000. But if you don't already have product market fit figured out, you're just going to throw money at a lot of things that aren't very strategic. And you're not going to do the degree of customer, you're not going to do the feedback loop and the accountability and the kind of the iteration of your product that you would do a little bit more if you're really having control of cash. And so if you look at, one of the funny things is if you look at the deals that had ValCaps on them, again, because of where the money was coming from, they tended to be much better structured in terms of the amount of cash a founder got at the beginning. They didn't get massively diluted. They didn't do a huge deal. They didn't do a tourist venture deal. And they tended to do what I would say would have a controlled ValCap, you know, controlled, reasonable, some of them still not, but a controlled, reasonable valuation with a smaller check, moving to product market fit, and then to a much, not necessarily a much larger check, but a larger check that they could be more strategic with. So I think, long-winded answer, but I think there's a lot of things going into why, when you look at the deals that had ValCap versus just base discount, that's why a lot of the base discount deals were coming from angel groups. And so, and then they shifted, and I think now most angel groups are using ValCaps too. So I think that's probably part of the answer to that. I don't know for sure that it is. Convertible notes and safe notes, it's kind of funny. When we first started Quake, we actually used KISS notes because I liked them better, to be honest. And then as we did more deals, had some challenges, we now just do post-money safes. And I just am honest with founders. Like, I'm like, everybody will tell you these are really good for you because you know what level of dilution you're going to have. But I'm just going to tell you what they also do is give you more dilution. So you're going to own, like, I mean, yes, you'll know how much dilution you're going to have, and it's going to be more. That's the answer, right? But I'm at least honest with our founders about it. But as an investor, they're so much better. One thing that founders don't realize, particularly with safe notes, this is one distinction between convertibles and safe notes, because sometimes convertibles work this way, sometimes they don't. Safe notes are far more dilutive to the founding team and everybody else than they are to each other. So if you stack a bunch of safe notes, looking at you, Sam. I'm just kidding. You just see this video. I'm just kidding. I'm just kidding. You're not messed up. But you know, when you stack a bunch of safe notes, yeah, yours are small. But when you see a team that stacks like millions of dollars, first of all, you shouldn't do more. I used to say you shouldn't do more than $1.5 million. It's stretched, but you still shouldn't do more than a couple, $2.5 million bucks, like on this stretch. And I've seen teams do $9 million in safe notes. You're going to get just clobbered in an avalanche when that converts. So you have to understand that, and the safe notes don't dilute each other near as much as they're going to dilute you as a founder. Convertibles don't necessarily work that way. They can, but a lot of times convertibles, they have different protections built in. So safes are so easy to talk about. That's why we all use them, safes and KISS notes and things like that, whatever structure you want, because we all understand that they're going to have similar terms, right? So I would say when we first started out, I used to kind of poo-poo safe and KISS and all that. And I said, you mean just, because I've been doing this for 30 years. So I'd be like, you mean a convertible note? But the reality is they just have, you know, again, some predictable elements in them. I would say most of them have, you know, you're going to find things like investor rights, liquidation preferences. Sometimes I would say as a founder, you want to, you know, we put those in some of our early deals. We stopped doing that, but you know, the liquidation preferences can be big. You know, for those that aren't familiar, that just means like if there's they're going to get paid first and they're going to get paid some multiple on their capital before anything else goes out. And that can be painful if you're doing a distressed deal. So it's something to be aware of. But you see a lot of the same things. You know, the discount rates are almost always controlled, and the market cap, like you said, pretty clearly identified. Pretty simple.
Excellent. And just as a follow-up question on the valuation and the decompression these days, I think at the inception of the safe note, there was this basic understanding that anytime you had an MVP, it would be worth roughly 4 million, right? Or more. But maybe, yeah, just against that backdrop and what's been happening in the ecosystem, what are you seeing with the valuation? Certainly you've come back down to earth, but
yeah,
you know,
so not at the early stage though, not as much, right? So where you see the compression dramatically is in the well, a little bit in the A for sure. We've seen like 15% discounts, 20% discounts in the A, but you really see the compression in the B and the C and beyond. You haven't seen that too much. We started seeing hints of that last quarter in early stage, but it really hasn't taken hold. One quick comment on that, you know, it's funny you said that, and I agree entirely. Like the onset of the safe note, we saw like 4 million, boom, like ideation, 4 million, right? But I do kind of laugh because again, our entry valuation, we've got a ton of investments. Our average is 3.6. And our typical deal has, now I don't want the founders who don't have revenue to be afraid to apply. We look at all kinds of traction, but our average has 30,000, give or take, in monthly recurring revenue. And the range is typically 30 to 100,000 in monthly recurring revenue against a valuation sub 4 million. How do we do that? Well, and I'm saying this to you as an investor, as opposed to our founders on the call. We don't hunt here where I am today. We don't hunt a lot in Silicon Valley. Now, there are exceptions. There's an interesting dynamic. It's just so weird to me. But we, as a fund, we have no focus on diversity. But we have some of the highest diversity metrics on the planet. And I think we're out of 3,500 early stage funds that were studied by Crunchbase, we were #1 for investment in diverse founders, women, Black, Hispanic, older, you know, whatever you want to, however you want to dice it. And I'll give you an example where we pull a deal from the Valley. We pulled Fran Meyer. Fran, awesome founder. I don't know if you know her, Sam, was a former co-founder at Match.com, founded Women.com, Trustee, which is a cyber verify company. That's 3 great companies. Came out of Stanford, so no argument about her educational background if you do think that's important. She had a company doing almost 100,000 in monthly recurring revenue, and she couldn't raise money here. It's focused on baby gear rental, and it's killing it. I mean, it's absolutely killing it. We were the first, I think we were co-invested with StartX out of Stanford. Between the two of us, we were the first 2 institutional investors, but she'd been working for 9 months trying to raise capital here. Why? Woman, 56, I think apologies, Fran, if you catch this recording, I'm probably not supposed to talk about 8 people's age, but I believe she was about 56 when we invested. And it's, if you're just not you younger founder, it's hard to raise money. And we've got a lot of older founders. We've got a lot of women founders. We've got a lot of Black, Hispanic, Pacific Islander, take your pick. We've got it all, because we don't focus on any of that. And I think so that, going to valuations, I think it's sort of funny that you're right. That was a lot of the companies that were driving that action, because there was so much money and there were so many checks and so much competition, and they were hunting in a lot of the same markets. $4 million was like the threshold. But if you're willing to go into Omaha, Cedar Rapids, Silicon Slopes in Utah, down into Atlanta, which is a great market, if you're willing to go into these off markets that maybe other people aren't hunting as much, obviously, you mentioned you're outside the United States. If you're willing to go some into these other markets outside the US, even, we did a bit of hunting down in South America and did really well, then you can find great value. And with lots of traction and revenue, and those kind of.
Actually, no, I cover the U.S., so I'm particularly fond of Utah, where I just was, as well as Seattle, your neck of the woods. So
interesting.
And I spent some time in Austin as well, but
I mean,
there's
Austin
a lot of
has
gems.
some inflated value too, though, because they got popular. And so you're right. I love Utah. We found some really great deals. One of the deals I'm hottest on right now is actually in Utah.
Cool. Yep, Silicon Slopes. Thank you.
There are a lot of unicorns that came out of Provo.
Oh yeah.
A lot.
Yeah, there's some really good talent relocated. Look, quality of life. So there's a lot of people from here right now that are relocated there. So it's not hard to find really good technical talent there right now. A lot of this digital nomad stuff is really, again, that's the other thing. I'm getting too old for that. And Bonnie, but I was telling somebody the other day, they're like, yeah, that's such coarse, such nonsense. And I was like, it's not. I was on a call. I'm going to share this. So I was on a call the other day with a co-investor in one of our deals. It's Chamillionaire. He's a rapper, singer who's got a big hit, Riding Dirty. And I don't know who the guy is. He's a great entrepreneur too. So I call him Chamillionaire. That's like, so I'm just out of touch. You've got to be current to be really, I think, effective. Bonnie, you do a great job of keeping your finger on the pulse. I get your newsletters, but it's hard. I mean, it's really, really hard to stay on top of it.
It is. I'm going to have fun with next week's editorial. I know we're out of time. We always go over, and I always appreciate you giving us the time. And I am going to have you and Joe Mylan on. Don't you think that'd be fun?
That'd be fun. Yeah.
So you'll have to tell me when you're back on home base.
Yes, when he was talking about, sorry to jump in, but like I didn't want to mention his name, but you did. Like everything you're saying is like this reporting, monthly reporting, like pacing of the investments. I was like, oh my God, it's Joe talking.
Yeah, I think it's a lot of similar viewpoint, right? It's a lifetime of observation of what works as on both sides of the coin.
So I know we have no more time. Any parting words of wisdom or caveats?
or how we can stay in touch with you?
Oh, I didn't know if you want to put your contact.
That's fine. You can get a hold of me. Obviously, some people had sent me notes prior to this and tried to connect on LinkedIn. I have a policy that I don't connect with anybody until after I've actually talked to them.
I have the same policy.
And it's just, I don't, if you look at my LinkedIn profile, I don't have a bunch of random people that I connect with on there. It's not meant as offensive. It's just meant that I want to actually have a relationship. So if you were on this call, just send me a note in LinkedIn and let me know we were on the call. That's how we connect there. If you want to send me an email, it's Glenn with 2 N's at quake.vc, Victor Charlie. And like I said, we're right between 3 and 4 right now. So those founders that are out raising capital right now, we have very little to deploy right this second. Very transparent about that. We do have some, about $1 million. That's really not much. But we write, our first check is typically 150,000. Again, we're trying to get into a round of about 500,000 normally. Sometimes they're bigger, but we write 150. Our biggest check follow-on is $1 million. So we're not going to be, we're more of a initial investor who brings a syndicate. We've got a very large network of co-investors, obviously a lot of family offices who participate as well, but we've got a lot of funds we work with. and we'll pull them in as needed. So that's who we are. Fourth fund will launch in, I believe it'll launch in October, but we may wait until the beginning of the year, just given how kind of things are right now. We might want a little extra time.
Thank you so much. Again, I wish you safe travels. And I'll send you some dates. When are you finished with all these travels? It sounds like you're going to be not until like late October, November.
Yeah, late October, beginning of November. I should be in pretty good shape. I got to do an event up here down here in Stanford in the second week of November, but otherwise I should be pretty free after that. So, or even slightly before that. So I would say November, anytime in December, I should be in pretty good shape.
We'll just do something. Thank you so much, and thank you everybody. And have a great day. As I said, safe travels.
Everybody take
Thanks so
care.
much.
Bye-bye.
Have a great day.